everyone. Today, let's dive into an exciting topic.
All right. Thank you so much for having me today. Again, like Ms. Deidre said, my name is Tamika Andugaham. I am the founder of Expert Business Advisors, and I will be talking to you about understanding alternative lending for small business. And we're going to talk about just how important it is to build business credit while you are building your business platform. This is some information about me strengthening your business one credit step at a time. My website information, if you need to go to my website, is here. Empowering business owners with structured credit solutions and financial guidance tailored for sustainable growth. Let me go back real quick. You also have a QR code to the right that it'll make it just a little easier so that if you want to go to my website and also follow me on social media. So this is about SCORE, Resource Nonprofit Partner of the United States Small Business Administration, successful and experienced business executive, volunteering time and expertise, helping new and existing business owners on the path to business success through free mentoring, workshops, and also resources. And also here is SCORE's information. You can also call SCORE, or you can contact the greenhouse if you need any information from them as well. Again, this is some more information about SCORE. SCORE is committed to helping every person succeed in their small business endeavors. We are dedicated to serving clients in diverse industries and at every stage of business. So you see the early stage, research, planning, startups, openings, established, growth, transitioning, and exit. And there's the SCORE information again at the bottom. Okay, so we're going to go straight into tonight's session, workshop objectives, understanding traditional versus alternative lending, benefits of alternative lending, key qualifications for alternative lending, and I'm going to also give you some real world scenarios. Okay. So one of the things I want to talk about is alternative loan factor rates. The alternative loan factor rates is typically different from some of your traditional loans. Factor rates charge a fixed fee based on the original loan amount, not the balance. So, and they also have no compounding. So you pay the same total amount whether you pay the loan off early or over time. Higher overall costs. Factor rates typically result in higher total costs compared to APR. So I'll explain to the bottom. So, for example, if you borrow $10,000 with a 1.2 factor rate, you would owe $12,000 in total, no matter how quickly you pay it off. So, just to make it more clearer, it won't fluctuate. The payments would just stay the same, and so you'll always know what your payoff amount is. Traditional versus alternative lending. So with the traditional most often have more strict underwriting, high credit scores. You have to have a high credit score with the traditional lending. So you have to have at least a 680 or above. And sometimes it take a long approval time. So I can tell you, and I think I'm skipping a little bit, but I just want to tell you, back in 2008, a lot of the alternative lending and fintech companies came about because of the strict guidelines with your traditional banks. So when I'm saying traditional, I'm actually talking about your traditional banks, your Chase, your Wells Fargo's. But however, if you can get approved through Chase, Wells Fargo, or any of the bigger banks, by all means, we will always want you to go to a bank of that sort, because that shows that you have really good credit and that you also you make sure that you're paying your finances the way that you should. So you should be able to get those loans. So, but if you can't, there's always alternative ways. The alternative, they have relaxed underwriting, quicker funding, lower credit score requirements. The evolution. So this is what I was talking about at the beginning. The evolution of business lending. Traditional banking dominated in the pre-2000s. The 2008 financial crisis led to strict lending requirements. Fintech lenders emerged, such as PayPal, Cabbage, Square. I don't know if y'all know, but PayPal, Cabbage, Square, all of those platforms have money to lend. So a lot of times well, you're paying fees. So because of the fact that you're paying fees, this gives PayPal, Cabbage, Square the opportunity to give back to business owners. So it's not checking your credit. It's going by what you actually put in. So the demand for alternative lending increased as banks rejected more small business loans. Imagine if every child knew how credit, business funding, and wealth building work. Let's change the narrative. I'm really big on generational wealth. So that's one of the reasons why I actually invest a lot of time in speaking to people about business credit and alternative lending and banking. Origins during the 2008 financial crisis. Do y'all remember that? Do y'all remember when everybody kind of lost their homes and I think it was it was during a recession. A lot of even some of the military lost their jobs at the time, but it was really a tight crunch for us in the United States. But we made it through. But again, like I said, that's how the fintech companies came about. Banks tighten lenders' criteria for small businesses. Alternative lenders emerge to fill the gap. Overcoming fear. Why business owners avoid business credit? And that's such an interesting question for me because I don't think that everybody have the fear. I just think that a lot of us don't have the knowledge. Because it's so if you have your personal credit and your business credit and you join those together, you really can maximize your funding opportunities to really make sure that your business is set up for success. Why is there such fear in using business credit for business expenses? Many business owners default to personal credit, putting themselves at financial risk. Mindset shift. 90% of business purchase can be made using the EIN instead of social security numbers. Misconception. Business credit is complicated. Reality is a process that builds credibility and access. It's definitely not complicated. It's probably easy. I would tell you it's actually easier to build business credit than it is personal credit. So, yes, right. Yes, I can. So once you, so there's three business credit profiles. There's Dun and Bradstreet, Equifax Business, and Experian Business. Regardless of whether you utilize your business credit or not, banks, lenders, nonprofits, everybody, they still judge you on your business credit profile. So, a lot of times we just say, I'm just not going to worry about it. I'll revert back to the personal. You want to make sure that you know what's going on with personal and also business. So Dun and Bradstreet, you will initially go and get your Dun and Bradstreet number. And then also you want to make sure that you monitor your business, your Equifax, business, and also Experian business. You will have reportings on there, and you will also get denied when you're actually. Let me back up. So you can get denied for funding for not knowing what's on your business credit profile, right? So, but you also, limit your chances of getting a large amount of funds. So, because banks are not going to lend to a personal social security number the same way they would lend to a business, right? But if you have both of those platforms, both in sync and both of them working well, you will also you'll see where you can maximize it. You don't have to use your personal credit at all for your business at all. You can actually just use your EIN. So we'll go back to where I said 90% of business purchase. I think that's what you're talking about, Ms. Deidre. 90% of business purchase can be made using the EIN. Yes, it is vendors, business credit cards. Um, Most of the time when you want to go and get a hard money cash is when you would use your social security number because you would personal guarantee it. I don't know if y'all understand about personal guarantee. Personal guarantee is meaning that you are going to guarantee your business is going to pay the money back that you would get from a lender. Exceptions for hard money loans, a personal guarantee may be required with the best interest rates. Here's the solution. Educate yourself on vendor credit, business trade lines, and separating personal business finances. So the vendor credits, a lot of times you don't know if they're going to report. So you want to always ask, is this going to help me? Will this actually report on my business credit? And which platform will it actually report to?